Excuse me. All right, guys, good morning. Good morning. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of Gar Capital. It is Friday, October 6th, 2023. Happy non-farm payroll day. Today was the jobs number that came out. That is released by I think it's the Bureau of Commerce in the United States. I think it's one of those job departments. I think Department of Commerce is it? Or Department of Labor, excuse me. Either way, the news came out. Let's go ahead and analyze it together. Got a couple things to go over. Just want to give you guys a reminder. Two things. Tomorrow will be posted the video for the recap of the week. We're going to go over what happened in the market, preview the next week, and go over our trading as well. Hope to see you there. Make sure to subscribe to our channel if you haven't already so you don't miss out on it. Make sure to hit that like button too if you do like these videos. And then on Monday, the bond market is closed for Columbus Day. I believe banks are closed on Columbus Day. I'm not really sure, but the stock market will be open. So regular hours on Monday. Columbus Day does not affect the stock market. Just want to give you guys the heads up. Dow futures down 210 points this morning, post NFP number. 170 points down for the NASDAQ. S&P 4251 down about 39 points. The Russell down about 0.85%. Rest in peace to my IWM calls. One moment of silence for that one. That was terrible. And it was green on Friday. We'll go over that on Saturday. Don't worry. Dollar index up 0.48%. The dollar continues to push a little higher even though we had some reprieve yesterday. The VIX up 6%. 1963, still below that 20 level. I believe on Tuesday we cracked 20 and then we rejected. So we're going to keep an eye on that very closely. Yields, again, let me know if you've heard this headline already. Highest yield since 2007. New 52-week highs in the 10-year Treasury yield, 4.854. Crude oil down about 0.18%. We were short on crude oil. We were green about 50 points. Then we moved the stop to break even, and then it went ahead and hit the stop post NFP. You could see the green candle here, just one of those stop hunts. Gasoline futures up 0.53%, $2.20. Put a couple of charts regarding gasoline futures on the blog. If you guys want to check it out, it's on our Discord. Link in the description below. Gold futures, the safe investment is down today, 1829, down 0.12%. Good morning, Alex. Thanks for being on. Silver down 0.84%, 21.19. $3.61 for copper futures, 1.66% to the upside for copper futures. Euro dollar below 105, 104.99, down about 50 pips. Dollar yen continuing that path to that 150 intervention level by the BOJ. Intervention meaning that they did something over there, the central banks. We talked about that, I believe, on yesterday's video, how hard it is to trade against the central banks regarding the dollar yen. We'll see if it gets above 150. Maybe Friday will be the save since there is no Forex trading on the weekends. Pound dollar 121.28, down about 62 pips this morning. Bitcoin down about 0.63, 430. 1619 for Ethereum. That is flat. Good morning, everyone. Let's go to the blog. Amen says, RIP to my IWM calls, Roku calls, and Netflix calls. It happens, man. It happens. We're in this together. Losses happen. As you know, if you guys been following us for a while, you know, I try to be as candid and as open with you guys. It's not easy. You know, and that's one thing I had to remind our group is that this is not supposed to be easy. It does take a piece of you. I mean, that's for sure. You got to be built different to do this every day. It's not easy. The swings, the highs and the lows, so difficult. But when you've been doing it for so long, you just get used to it. It's kind of like riding a bicycle. Once you learn it, you kind of don't forget. Let's answer some questions rather quickly. You guys are ready to rock. Giacomo, I hope I don't mispronounce. I hope I don't mispronounce that name. Hi, Carlos. Hello from Italy. I'm a fan since about 3 or 4 years, but it's my first time joining the streaming. Really glad about your work. Oh, thank you, man. Oh, man, Italy. Funny thing about Italy is that I've been dying to go with the wife to check it out, and it's really just time. It's really hard to get me out of the desk, as you know. I really love doing this, so I'm kind of a workaholic. Looking at markets and reading all day. I absolutely love it. I always have to be in front of a screen. But Italy, man, I am dying to go, Giacomo, to check it out. I like Italy soccer. I like Inter. That's my favorite Italian soccer team. So, man, what a wonderful country. Thank you for watching from over there. I'm absolutely honored. Do you think do you think the trend will continue to the downside on SPY? Yeah, let's go ahead and kind of pivot to that. We're going to go over the news flow today. A couple of headlines that came out: restaurant and bar employment surges back to pre-pandemic levels. That's always a good sign. 336,000 jobs were added in September, above expectations of 160,000. That's the 33rd consecutive month of jobs growth. That is pretty much on the high end of past streaks. The largest streak being from around 2009 post-recession to the 2017, around 2017, 100 months in a row. What I'm noticing about these kind of trends is they tend to happen post massive decline, post recession. You can see how much the jobs number fell in 2020. I know this is not to scale, obviously, but you could see the recovery. That's always a good sign. And I want to pivot to that. You're probably thinking to yourself, well, Carlos, we had a great jobs market. People are working. How can the stock market not like that? As we know, in terms of inflation, we have to look at always the inflation angle. That's the key thing here. We already fixed supply chains for the most part, automotive, retail. I have noticed personally that on the Nike app, there's actually shoes. So remember back in the day, 2021, 2022, you couldn't get a pair of Dunks on retail. You had to go on StockX. And the reason I'm saying that is that the fact that now that supply chains have caught up, that's obviously deflationary. But the more people that work, more people that are employed, they're going to spend money. They're going to go and spend going out to eat, going out traveling, buying stuff on Amazon on Prime Day. Demand is still strong. You can't have falling inflation if you still have demand. What the Fed wants is price stability. Price stability meaning that we don't care if you lose your job as long as prices go down. That's kind of the deal. Starting to see the S&P bounce back here a little bit. Again, we haven't opened yet. This is all pre-market. So we're going to be very careful in watching everything. Just want to give you guys the heads up. So with that being said, let it be known now, guys, that when they're talking about rate cuts, and I want to pivot to the actual headline itself. Here's the headline. Fed swaps shift full pricing of a rate cut to September from July. If a company or a dealership or a store is having a sale, it's pretty much one or two reasons. One, they want to drum up business, volume. And the second is to get sales, new customers or new sales in order to attract, as we know. There's always a price for every buyer. There's always a price for every seller, as we know. Price for every buyer is Lamborghini calls you and says, hey, do you want to go ahead and buy this Lamborghini? If you come right now, it's $100,000 off the lot. You already know in your mind that Lamborghinis are worth $200,000, $300,000 in intrinsic value from what you are perceiving. So $100,000 to you is a great deal. There's a price for every seller. You own your home, you love your home, it's a family heirloom, whatever reason, maybe it's a family home and you own it. But someone knocks on the door and says, I will offer you $5 million for your home, sight unseen, right now, cash. You're probably going to take it. And that's what creates a market. So in that term of demand, the demand is still there as long as the labor market is. How do we know that? Well, you wouldn't have jobs added if people are not shopping or consuming. And then again, the more people that consume, obviously, the more people are going to be employed. And then those employed are going to consume. And then it keeps going higher. So when they talk about rate cuts, guys, they're talking about recession. You don't do a rate cut when the economy is good. It doesn't work that way. You do rate hikes when the economy is too hot. So where we are, in a sense, not in terms of assets. If you are a mortgage broker, if you are a hedge fund manager, if you're a real estate agent, it's pretty tough out there. I can understand with high interest rates, it's a new environment. This is a very difficult time for those in the asset-heavy industry, whether it be investments of stocks, bonds. Of course, bonds have been getting hit, as we know, or real estate, large assets. But if you're working a 9-to-5 job, let's say you're someone in the military, maybe someone in the public workforce, maybe you work for the county clerk's office, police officer, firefighter, what has changed other than inflation falling? You still have a consistent paycheck. Your dollar that you have in your pocket versus currencies overseas are actually stronger now than it ever has been this year. If you're a saver, if you're, let's think of your grandma, for example, that's, seen the craziness of market swings and they're very conservative. This is the first time since 2007 that those savers are actually going to be rewarded for their saving. They're going to get 5% yields on a CD, 4.5% on a regular savings. So there's always that one-side approach, back and forth. Every country out there, for the most part, guys, in Europe and in Asia, has inflation. The United States is not an isolated country, as we know, still interconnected. But again, the dollar being key, this is what we know. This is the dollar index versus other currencies. Pretty strong, right? If we go to the daily, and again, breaking out, obviously, I'm still waiting for 105.70 for a pullback. But the currency itself is important because this is basically a survey or a view of the country economically. So when people say that the United States economy is in shambles, I'm not seeing it from the price action, at least from the macro side. Again, you don't get rate cuts in a good environment, in a good economy. So when they're saying they're pushing it down, that we're going to do the first rate cut in terms of pricing the Fed swaps, those are insurance contracts derivatives, they're basically saying that we don't expect a severe recession until next September. And I think what the Fed is trying to say when you have these different speakers, that we're going to keep the path, what they're telling us behind the scenes and between the lines is saying the economy is great. We don't need to cut. And it's so good, it's so strong, picking up. GDP number is strong, unemployment is down, and any other economy, any other country would love that. So what the Fed is telling you is that higher for longer means the economy is pretty steady. What does that mean for S&P, and what does that mean for stocks? Good question. This is why we're here. So the S&P, I believe James was asking me, do we have a little more? Two levels we're keying on S&P. 42.33 on the futures side. I'm going to go ahead and bring up S&P 500, regular spot. Here we go. You got 42.05. That's your 200 days. So far, we've been holding it. That is the key. And we also have a trend line here. If you're noticing, we're starting to bounce. If buyers can defend this level, that is a very good sign. All we need to do, guys, remember what we talked about, seasonality? We really just need to get through the damn month. We just need to get through that first 2 weeks. So let me go ahead and get that seasonality chart rather quickly. My apologies. Let me move this over. Okay, I believe it's on the desktop. Here we go. Again, this is the same map we've been using all year, the seasonality. Again, it's not perfect, but man, it's pretty close. Still got a little more. If we can get through, I believe, October 16th, above the 200-day, or at least above the 50% retrace, I think as we get into November, that's the bottom. The bottom will be done. I highly, highly doubt that in November, December, being strong seasonally, especially November, that we're going to get a continued fall. And this is recorded, obviously. So again, feel free to laugh at me in December if I'm wrong, but that's what I'm seeing. The buyers have to defend that level. Very difficult to short when everyone is short. Remember, put-call ratios were very elevated. We got the weekend coming. The bond market's going to be closed on Monday. May that affect liquidity? May that affect the market? We will see. But in terms of continued downside, yeah, we can. If we can break the actual week's lows, so far it seems to be holding. We are at very key levels of support. I would not be surprised if they just chop us up today because we have the bond market closing on Monday. We'll see how the day goes, but it's not looking great. I actually see it's more choppy than anything else. What do you think about gold at this level? I'm aiming for an actual gold ounces. All right, let's take a look. GC. We're going to go to the daily. Let me see if I can. Okay, that's the weekly. Duh. Here's your daily. Oh, terrible. 61.8 retracement level at 1798. It is very ugly on gold, and the real reason is because of the dollar. So what level are you looking for? I think sub 1800 is definitely a possibility, and that's probably the place you're going to. This is why this is important, because you have gold priced into dollars. Gold priced into euros is completely different than gold priced into dollars. So just remember that. Might have hit a possible double top on the dollar, so we may get a bounce in gold even if stocks are up, because the dollar may go down. What I'm looking for is 105.70. We're about $1 away from that, no pun intended. Really the level, if you're expecting more, if we wanted to get to around 1800 gold, you got to get above 107.35 on the dollar. I think gold futures just went green, 1833. So we're starting to see a bounce a little bit. How interesting. Gold and the S&P are kind of moving in tandem, right? S&P was down, gold is down, S&P was up, gold is up. And the reason right here is the greenback. Very, very important. So no, I wouldn't say yet. I would say 1800. You can place an alert there right around that zone. That would probably be the level to go ahead and add your gold coins. And then you might be up or down $60, $50 depending on the volatility of that day. There is commissions to be paid in terms of gold, so make sure to find the right gold broker, because remember, there's additional fees on it. So again, if you see it as an investment, obviously you want to make sure your ducks are in a row. But if you just like actually owning physical gold, then go for it. I think APMEX is a great place to buy gold. That's where I have, that's where I got my gold from, and a platinum coin. Very nice stuff. Let's see. Good morning. What sectors or stocks would you deploy capital if the market goes into a recession? Really, the things, look at the things in a recession. What was the last one that we had? The last recession, technically speaking, was in 2022. What did well? Energy did well. Value stocks did well, which was the dividend payers, Procter & Gamble, Coca-Cola, some more of the staples. But not all recessions are built the same. So you kind of have to look at it at the prism of what kind of recession is it. If it's a credit recession where people just don't have money, yeah, that's going to be something where you're looking for just the basics, utilities, energy, and consumer staples. If it becomes a recession just in terms of GDP, but the labor market is still relatively fine and the yields are still going up, then you're looking at more discretionary tech stocks, possibly even banks. Because if the labor market is still strong, deposit base is still strong, then banks will be fine. But these yields are going to get to the point it starts ratcheting up higher and higher, puts a little more stress. I think we need to also look at the prism of, easy money policies are not here anymore. We are now fully recovered from the COVID recession. So kind of getting back to that point, we would need something bad to happen. A credit event meaning, waves of bankruptcies and people losing their homes. Think of 2007. Again, most people have their homes are below 4% in interest rates. They all took it in 2020 and 2021. So, that's something that when you're doing research as a trader, you kind of have to always kind of write down or think about, what lawyers called red teaming, where you actually have to have the opposite side of what you're thinking so you can open your mind up. So let's say, for example, you say, man, the world's going to end, sell everything. It's always good to have somebody or have the state of mind that think of the other side of the coin. What could happen for good things? Like, well, what would make the stock market go higher, for example? It's not good just to have one-way thinking. It's good to weigh both sides to make sure you fully understand the environment and possibilities. Because at the end of the day, guys, all we deal with is in probabilities every day. There's no sure thing in the market. No sure thing whatsoever. So all we can do is, risk our capital with probabilities being weighed, risk obviously defined over and over and over. And that's being a trader every day. Fun stuff. All right, guys, we'll go ahead and leave it there. Have a great rest of your Friday. Stay safe out there. I will see you guys tomorrow for the next video, which will be our recap video for the week. Got a lot of lessons to learn, a lot of things to talk about. Always enjoyable to speak to you guys. Have a great rest of your Friday. Cheers all.